So I'm thrilled to be able to introduce to you our panel today. So let me start with Vikram. Vikram Widge is currently the Senior Advisor at the Climate Policy Initiative, where he supports strategy and programmatic development, as well as guides the financial aspects of CPI's analytical work. With over 3 decades of leadership experience in climate and development finance, he most recently served as the global head of climate finance and policy at the International Finance Corporation. Vikram specializes in bridging public finance with capital markets and investors to drive transformation to a low carbon, climate resilient future. He has led the development of a Breathe Better bond, a forestry bond, and a low-income African clean cook stoves financing facility, all of which have won numerous awards. So welcome to you, Vikram. And then I have Dr. Serena Guarnaschelli, who's a partner at Suisse, an impact finance firm that turns issues with high societal and environmental impact into tangible investment opportunities. Serena is an expert in blended finance and impact investing and inclusive business models across agriculture, health, and energy. She brings almost 2 decades of strategy consulting experience with the likes of McKinsey and Dalberg to the table. She has experience in structuring innovative finance mechanisms such as blended funds and impact investment funds. She also has recently supported one of the world's leading impact asset managers to design a catalyst facility at the intersection of agriculture and climate. She has also designed and launched the Convergence platform, a blended finance platform focused on emerging and frontier markets, and acted as the interim director of the investment network during its first year of launch. Welcome to you, Serena. And finally, I'd like to welcome Dr. James Gifford. James is the head of Sustainable Impact Advisory and Thought Leadership for Credit Suisse, working with the bank's clients and advisors to mobilize capital into impact investing. He also teaches a program at Harvard and the University of Zurich on impact investing for the next generation of ultra-high net worth family members. He was the founding executive director of the UNPRI, the United Nations Principles for Responsible Investment, and led the organization from inception for a good decade. Other roles that he has had include the head of impact investing at UBS and a director of impact at TAU Investment Management. So welcome to you, James. And with that, let's get started into the substance of this discussion. Just a few opening comments from me. We know that financial resources and sound investments are needed to address climate change, to both reduce emissions, promote adaptation to the impacts that are already occurring, and to build resilience. Enshrined in the Paris Agreement is $100 billion per annum of public and private commitments from developed nations to finance the agreement targets. Just 6 months ago, the UN Climate Action Task Force released a report from experts that indicated shifts in capital flows are not yet sufficient, and private sector finance for climate action remains highly concentrated both sectorally and geographically. Meeting the commitments in the Paris Agreement will require mobilizing capital from a number of sources, but particularly from investors, institutional investors at scale. This is a crucial point. Institutional actors hold the keys to capital. Public players account for about 44% of climate finance available, whereas about 56%, according to this report, is provided by private actors. And the number is likely to be underestimated due to gaps in the data. There is good news on the horizon, though. I want to acknowledge that many financial institutions have exercised strong leadership and inspiring ambition through their public commitments to finance climate action. That said, there's still more work to do. New financial structures and business models will be needed. Bottom line is that the more thought and attention must be given to how institutional capital can be mobilized towards climate action, especially towards solutions in emerging markets. So Vikram, let me start with you first of all. In your experience, what do you think it takes for institutional investors to invest in climate action? And perhaps what might stop them from doing so?
Great. Thank you so much, Dean. And thank you to GIN to have me here and your very generous introduction. Great to be here on the panel with these August co-panelists. Look, I mean, in many ways, at least in the emerging market context, which is where most of my experience has been, unlocking institutional investor money has been a bit of a holy grail. And over the years, one hopes that it's not like the true holy grail, as in never to be found. But the idea is that how do we do exactly what you are saying needs to get done ultimately to ensure that we end up in this transition to net zero. The organization I worked for years before I joined them sort of established itself as sort of a leader in tracking climate finance. And the most recent report they did on the global sort of landscape, only about 600 billion is flowing on average about a year. And while that number is way below what is needed anyway, the point is that the institutional investor bit is only about 10 billion. If you throw in some of the PE funds and the infra funds, it's probably another 10 billion. So 20 billion out of 600 is pretty poor, sort of, I wouldn't say a poor showing, but a fairly small fraction. As importantly, we hear that there are trillions locked up in global savings that all these institutional investors are doing. So how do we match that availability? People say, oh, there's no shortage of money. Well, is it a shortage of deals? And if you look at least in the emerging market context, it may or may not just be a shortage of deals. There's a whole plethora of other issues that I think plague the institutional investor community in actually being able to.
And what in your mind is the biggest one, do you think?
Right. Okay. So one of the biggest things I think is scale. The institutional investors, to me, are not agnostic to. There are a few things that they like, right? They like size. Nobody wants to get out of bed unless it's $100 million check. And so, if they don't want to be more than 10% of the deal, then that deal's got to be pretty big in size.
Okay, so scale really matters.
Scale matters hugely. Okay. The safety, or what I would call risk, matters a lot, because they are at the end managing money for the long term for their pensioners, broadly speaking. And the other thing is simplicity matters. I mean, my scale, safe, and simple. If we can sort of figure it out and start delivering products that meet these requirements, I have a feeling we could unlock a lot of them. Let me give you an example, right? I mean, an example is always useful. How do we go about this? These are challenging. By the time you aggregate enough transactions, which is what gets to scale, by the time you de-risk them, pool them, figure out enhancements, and then securitize them into bonds, and we should talk about that also maybe separately. It's quite an sort of undertaking. But here, an example, let me give you a live example from the Global Innovation Lab for, sorry, you want me to stop?
No, that's fine. I'm going to come back to the example, Vikram, if I can, but I want to just pop over to Serena, if I may.
Oh, sure, of course.
Because I think she has some interesting points on how do you take that scale, simplicity, and safety. So Serena, how do you address those kinds of things? What matters for them?
Vikram already played all the right notes. So I'm hoping to kind of like connect the dots, bring an additional perspective and some examples from my experience. But just to say, I share very much of the overarching picture and hypothesis that there is capital that is investing in this space. CPI estimated, for example, the amount of capital invested in climate finance in 2018 around 546 billion. So there is a lot of money. And a lot of the stuff you can read as a positive trend, 25% increase on a 2-year average. But when you look at it compared to the needs, and also when you look about how capital is deployed, I think it does speak that a transition needs to happen. And I'll talk about scale, risk, and simplicity as I transition towards solutions and what's currently in the market. But just to currently, most of the money is, as Vikram knows better than I do, in mitigation, right? So there are a few classes, low carbon transition, renewable energy, energy efficiency, that capture over 90% of the capital right now. A small percentage into adaptation. One could see it as a huge opportunity to invest more in adaptation and to invest more in integrated solutions between mitigation and adaptation. And a very small percentage that look at what in the, perhaps through the lens of institutional investors are emerging asset classes, but are perfectly investable asset classes for like sustainable land use, sustainable forestry, and so on. And on the other side, you have the needs with the sustainable development goals, and everybody talks about exciting business opportunities of the size of trillions, food and agriculture, low carbon. So, and when everybody talks about investment opportunities, so why is capital not flowing? And I think it's the difference of few letters between investment opportunity and what's investable through the lens of whom.
So how do you make it investable, Serena?
Yeah, so I'm going to talk about, for example, specifically in the case of institutional investors, right? Yeah. I'll take one example, and then I'll go through other intermediaries that are at scale to and have successfully attracted institutional investors. So how do you replicate that success story? So one structure is actually about sustainable forestry, right? So the timber investment management organizations are well established now. Asset classes they went from 38 million about 20 years ago to over 6 billion. And you have managers with track record. Most of these assets are currently held in the US, Australia, and New Zealand. So there are a series of policy and country specifics that are preventing replication scale. But just to say, some of these funds, like New Forest,
Hold on a second. I think we've got somebody that is not muted at all. Maybe our tech support can actually address that for us, if that's okay. Thank you. Sorry, Serena, you go right ahead.
And they are launching funds in emerging markets. But when you compare with very similar structures, and I'll talk about what catalytic capital, the role of catalytic capital in the structures, but when you look at the size of what they're launching in emerging markets, so for example, if you take New Forest, their first Southeast Asia fund has a target of 170 million compared to 6 billion. So it's still an emerging asset class and small. And this begs the question about why is there a difference? It's a fund manager with track record. They have the same layer capital where they promise double-digit interest rate, same features in terms of what institutional investors might desire in terms of size, liquidity, and so on. So why so small? And so one thing I wanted to put out there is that I think as it tracks, as it happened for clean energy or for private equity investment in emerging markets, there is probably a higher sense of perceived risk compared to the real risk. And so we're really in a transition phase where catalytic capital can bridge this transition by offering, for example, risk mitigation mechanisms that hopefully, because of the underlying nature of the assets, will not be needed in the longer term. And I'll make maybe another kind of like call for action, the last point for institutional investors, which requires a different capital allocation. Right now, a lot of the capital is allocated to climate finance, which, as I said, mostly towards mitigation. It really needs to start including nature-based solutions and adaptations at large.
So Serena, I'm interested in this thing about mismatches in understanding risk. Do you mean that institutional investors might have a different view of risk relative to what is actually there? How do you solve for that?
Correct. And I think part of it is about, so one way to solve around this is to work with intermediaries that have experience in asset classes that have worked in developed structures and look at how to translate in emerging markets. It's a little bit trickier in relatively newer asset classes, but we see very similar products and very similar investable products, for example, in the space of sustainable supply chain. As you know, this is a space where there's huge demand and huge possibility for securitization with corporate off-takers. So I could talk about some transactions I've seen in Indonesia with the Tropical Landscape Finance Facility that work on a deal basis, so project by project. And their first bond was a $95 million sustainable rubber bond with Michelin as an off-taker. And then they offer loans to farmers to actually work on degraded land. They supply also livelihoods in the transition phase. And then they sell the notes into the capital markets, senior and junior. So a lot of these structures use layer structures where they attract institutional investors by packaging it with a more concessional investor. This could be a foundation investing on a mission-related investment basis or development finance institutions, and they're willing to accept a lower rate of return. Or in some structures, very interesting, they have the same rate of return, but they forgive part of their return to be reinvested
Okay.
To promote, for example, less business as usual support to the investees in the portfolio. So we see a lot of role that catalytic capital can play, and also a lot of packaging, intermediation, and aggregation that needs to happen for then institutional investors to, as Vikram said, to be offered a product of a certain ticket size, of certain terms. But a lot of work, and there are a lot of transaction costs and a lot of role for catalytic capital, not just as an investment, but also in the early development stage costs, as well as the transaction costs for aggregating smaller deals.
Okay, so the structuring and packaging is quite important, I hear you say, right? James, let me talk to you, if I may, is that I particularly liked in your recent paper that you suggested that investors need to take to address climate risk and opportunities and solutions. You were suggesting some ways in which there needed to be earlier stage investment in venture capital, and not typically a place where institutions might play. But can you suggest some of the practical ways that you see this happening, where pipeline is brought to scale that might be attractive to the likes of yourselves, for example?
Yeah, absolutely. And look, I love hearing Serena talk about the early stage, high impact world, but it is still such a tiny world compared to where, Credit Suisse over $1 trillion in assets under advisory, and still, I mean, it is over, I think, 100 billion or so unsustainable, but still in the sort of single digit billions in impact, and as strictly defined. And I think the reason, and mainstream investors really need to think carefully about the mechanisms of impact. And this goes for any impact, not just climate impact. But there are really only two mechanisms. And one is capital allocation, but only in the inefficient end of the spectrum. The earlier stage, inefficient markets. Once something is up and trading, and it might sound really obvious to half the people on this call, but I'm amazed at how many people think that simply by investing in a large cap stock, you're really making a difference to the world. Well, no, most of the time you're just swapping ownership with somebody else, and they're going to go and buy something else, and nothing really changes. And of course, if an entire market pushes in a direction, yes, you can bump up, you can push up the price of stock and lower the cost of capital. But at the end of the day, that will, fall back to whatever is based around fundamentals of the company. Every single fund manager in the world is incentivized to outperform their benchmark. Every single one, every sustainable one. They're going to find ways of getting out of overvalued companies and getting into undervalued companies. However they do it, they'll find a way. So, we felt it's really important to distinguish the mechanisms. And the other mechanism, apart from allocating capital in earlier stages, is shareholder engagement and activism. Okay. And I think those are the mechanisms, and large investors should be laser focused on allocating capital into funds that are really using their investor power to push companies. And the Climate Action 100 Plus Coalition is a great example. And we are a very strong supporter and member of that. And actually trying to seed funds, which in the liquid markets can deliberately invest in companies that need to improve, and then work with those companies, inspire them, push them, jump up and down if necessary to get them to improve, while at the same time increasing allocation to private markets considerably. And again, large banks typically don't do venture capital. In fact, most large institutional investors don't do venture capital. There are some notable exceptions.
Yeah. So when you talk about, pushing money into the more, not necessarily in public markets, but in private markets, for example, while you might not do venture capital, the kinds of structures that Serena's talking about, when does it become attractive to you?
Well, let me just stick on the venture capital point for a minute. So, so we didn't do a lot of venture capital, and most banks don't, but we just did. So we just announced, it's publicly announced, that we raised 318 million for a climate innovation venture capital fund of funds. Now that is highly unusual. That includes some very early stage companies, seed stage companies as well. And the way we did that was pooling the risk. And so rather than just bringing one fund to our clients, which would have been subscale and way too risky, we put it together in a fund of funds structure, which I think solved a lot of challenges around risk and scale. And the other challenge around funds of funds is tenor. They often stretch out to 15 years.
Okay.
The great thing about climate is that there are many, many funds in the market now. And so hopefully that tenor can be, that investment period can be much lower than a typical strategy.
And on that note, I just want to revert to Serena, because when we did a prep call, one of the things that she suggested with me was that there's also this mismatch around timing. So Serena, I wondered whether you might be able to comment on that particular challenge. And just before you do, I just want to remind everybody, please to direct your questions to the question in the chat. I can see lots of questions coming through, and we're going to get to them in just a moment. Serena.
Yeah, so put very simply, I mean, recognizing the features that institutional investors and banks need to invest in this place, I just want to bring forward, having worked more on the pipeline development side and the structuring side than the supply, than the investment side, there is kind of like a time horizon mismatch, because a lot of opportunities we see, particularly in the sustainable land use space, do have a time horizon for both environmental economic benefits that go hand in hand, that materialize often outside of the time horizon that institutional investors or even development finance institutions have. So for example, if you take a project that looks at restoring degraded land while planting something more sustainably, sometimes you do really reap the benefits economically in periods that sometimes actually exceeds the 10 years. And so even from an investor lens, I think some structures that currently allow investors to come in and out, but like Evergreen Fund, kind of reflect that longer time horizon that takes to actually reap the benefit and secure the impact side, so that it doesn't fall through the cracks when the fund sort of like exits.
Okay, all right. Vikram, can I revert to you a little bit? You alluded in the beginning to the idea of something that I think is well known in the market, but you could call it packaged, as it were. But some instruments, things like bonds, for example. Do you want to just comment on, there's been an enormous amount of capital flowing into things like green bonds, for example, but does it just stop there, or do we need to do something more to mature those kinds of mechanisms?
Oh, look, I mean, just sort of to bring it together with what James and Serena have said, and I think bonds were the green bonds were an interesting introduction into that sort of a colored flavor of that asset class, so to speak. It goes back to the earlier issue of scale and risk and simplicity. Institutional investors understand bonds. Some of the examples Serena gave, and some of the work that James and Credit Suisse are now doing is fantastic. But look at the scale of that compared to the need. The story Serena talks about, it's about the quality of impact. That should be important to everybody. But how long do we have to spend all this time to put out $100 million in that kind of a framing, right? So in that sense, I think the green bonds were a great product. I honestly thought they'd be a great starter product. 10 odd years in, and they're about $1 trillion worth issued. Firstly, while we should all be celebrating that it's $1 trillion, it's a minuscule fraction of what the bond market is. So arguably, if there is so much need, why is it only a cumulative $1 trillion or so far, right? So that's one. Two, like I said, they were meant to be a starter product. The idea was that you would start with AAA rated multilaterals like IFC and the World Bank that I work for, you do corporates, but that it would move beyond that. It would move to a point where people were actually aggregating and de-risking and securitizing transactions and perhaps delivering them through notes and bonds. That is happening, but in a very limited way, right? I mean, this whole risk averseness seems to have stuck us into this high quality, investment grade plus type rated bonds, and they're all corporate risks. So what is it actually doing to transform the market, right? I mean, most of these institutions were going to do this anyway. I don't want to get into the debate on additionality, which is probably a whole conference by itself. But the point is, we need to push beyond this. And if this is the kind of difficulty that James is having and Serena was talking about in OECD markets, can you imagine the challenges for institutional investors in emerging markets? When you take all the risks of Europe and America and you overlay FX and political risk, at which point there are solutions that you need that go beyond just addressing the climate issues, right?
But I think, Vikram, you're absolutely right. But I think we should talk about additionality. I mean, without additionality, we're not going to get there. And I think your point was, very well taken on the green bonds. If they're investment grade green bonds, they're going to be oversubscribed, right. And it means that the work has been done in the project finance phase, and somebody else has taken the risk to make that project happen and build it, and they're probably refinancing it once it gets down to to an investment grade bond. And certainly, so what it's saying is that I'm sort of also challenging that there's all this money on the sidelines waiting to get in. Well, they're going to get into whatever they're going to get into. So the bottleneck has to be earlier up the chain. Up in the project development and the venture capital.
And how do we introduce investors into that, right? I mean, let me just give you an example of this fund called the Climate Investor One Fund. Probably we're going to need 100, 1,000 of these, but this was one of the earlier sort of graduates of the Lab Accelerator program, and it's raised $850 million, $50 million to do development financing, to do project level work, to get them feasible into the make them financeable. And then about an $800 million fund that's layered in a way that allows institutional investors to be in the senior tranche. There's other concessional money and DFI money below them, but it at least allows them to participate in directly looking at a pool of renewable energy projects in this case, which ultimately post-construction get refinanced with more institutional capital and less sort of, if you will, credit enhancement needed. Now, all right, that is where we really need to go. And you're absolutely right, James. I mean, oversubscription, there is no premium per se. I mean, yes, that's another debate, but oversubscription should not simply be taken as a basis of saying, yes, we are successful, we're done. I think we're just getting started.
There are loads of questions that are coming through in our question thing, so I'm going to direct it to that, if I may, and I'll try and paraphrase them as best as I possibly can. So the first one off the bat, which just takes us out of this big scale right down to the small one, is how can a small investor, say $20,000 to $40,000, invest in leveraging climate action? And Serena, I'm going to direct that to you, because I think that sometimes that's often just the sentiment of the average or medium person. If I look at my own assets, for example, how do I get in, and how do I have the likes of big institutional players that are maybe moving some significant margins here play a role?
Yeah, I think we're talking about the level below what James was talking about. And I do think, by the way, fund of funds are absolutely an exciting opportunity that reflects also that there is a rise of intermediaries and funds and quite a diversity of fund products across, as I said, asset classes, markets. And I think it can satisfy almost all like the flavors of the rainbow, one might speak. For example, we're doing a lot of work in regenerative agriculture, and there's opportunity both for institutional investors into debt-like products or real estate-like products, but there are also opportunities below that to work. For example, there are a lot of what I would call service providers that these intermediaries work with. They're actually packaged, they work directly with the cooperatives, they do provide financing and technical assistance. So all along the supply chain, you may imagine, that leads you to the type of products we've been talking about. There are a lot of exciting intermediaries, and a lot of them operate on a commercial basis, but they do directly link with the projects. For example, whether it's in Indonesia or France, they work with cooperatives, they support them directly, they aggregate, and that gives you also more direct impact, depending on what kind of investor you want to be also. Exactly. If you want to be more engaged into defining the impact thesis for some of these products.
Yeah. So, I mean, funds of funds, for example, are a rising opportunity, but not only for the individual, but also for institutionals that maybe are at smaller scales themselves, which is fantastic. Thank you, Serena.
Absolutely.
So let's go to the next one. Where are the most pressing needs currently for catalytic capital or catalytic structures? And particularly, specifically, how they might relate to developed markets. Vikram, I know that you've got a significant experience in emerging markets. Do you want to just comment on that one? Where do you think the biggest challenges or needs are for catalytic structures at the moment?
Yes, absolutely. If the question was for developed markets, this answer may not apply, but it also may, because the risk profiles are different. But some of the sectors, I think Serena already mentioned, the whole issue around sustainable and regenerative agriculture. Clearly, that is the catalytic capital is required in a lot of these cases because of the whole issue around, there's just high transaction costs to start with. Development teams, this fund of funds, how do you get to a fund of funds if the fund team does not have the ability to actually get its thesis done? So the sustainable agriculture, there's related to that nature-based solutions we keep hearing about, and which are going to be huge in terms of, if you will, the resilience aspect of trying to deal with mitigation. There's the whole sustainable energy access. The Rockefeller Foundation recently announced $1 billion moonshot, the whole reducing energy poverty in the context of that. That requires a lot of catalytic capital. And then there's the whole issue around supply chains. COVID has made that. How do you make them low carbon? How do you make them resilient? How do you diversify them? So there's the whole issue around supply chain. And finally, I'd say cities. I think given that they are such a big anchor or sort of source of emissions, the whole spectrum around sustainable cities, whether it's buildings, energy efficiency, upgrades, public transport, that whole spectrum, again, is underfunded, but also because of the issues related to risk can do with catalytic capital. Right? The way I look at catalytic capital, it is patient, it is flexible, it is risk tolerant, and it is somewhat concessional, not in terms of its commercial demand, but in terms of its ability to trade a little bit of the return for perhaps high quality impact.
Flexibility is what I'm hearing you say. Okay. James, I'm going to direct the next question to you, and I hope that I'm not showing you a little bit of a curved ball, but there's a question that's come up is, to what extent should nation states look at the use of their tax system to incentivize investors to channel their investing to address climate emergencies or any climate action for that matter? What thoughts do you have on that? I know that institutionals deal a lot with regulatory frameworks, so tax is probably just one of them.
Yeah, look, I mean, I can't comment on tax, but in terms of, there are still obstacles, regulatory obstacles in the way of allocating capital into retail investors. Now, by no means, arguing a regulatory lobbying point here, but retail investors are able to, invest in a Ferrari and a restaurant in Manhattan, which will almost certainly go bankrupt, but can't invest in private market impact funds. So that, to me, and again, look, I understand investor protections and so on, but I think it would be interesting to explore how retail investors can get access to more, and they've got to be institutional quality, they've got to be appropriate and so on, but more impactful products. And actually, this goes to Serena's question that was put to her about what can somebody with tens of thousands of dollars do for impact. Well, currently in Switzerland, you can do microfinance. In some countries, you can't, but most of the time you can't do venture capital or private equity at all. But what you can do is shareholder engagement listed funds. And there are now more and more funds out there who have very explicit, well-resourced teams that are doing shareholder engagement that retail investors should be supporting. And it's not the first question that people ask when they go to their wealth manager or they look at a fund platform. They're not saying, which of these fund managers create the most impact through shareholder engagement? That's just not a question that's asked very often. People are like, oh, do you have tobacco, or do you have, are you invested in more thematic? How legitimate is your ESG process? Well, actually, if you want impact, you want to be asking, how much resources are you putting into shareholder engagement and activism? How are you voting your shares? That's far more impactful than what stocks
proactive.
you're actually selecting.
And Dean,
proactive.
maybe if I may, both on this
Serena.
question and the previous one, the role
and
of
I have another
financing.
question for you too.
Yeah.
Okay.
But maybe it's a bit provocative, but because just using as an example, I don't shy away from using public finance to actually kind of like level the play field. When you look at regenerative agriculture, you're up against a system that is heavily subsidized and has been for years across many countries and many commodities. So you're up against that. And so I do think that there is a fair use of subsidies, but in a very targeted way. My ask, usually my call for action is for government, public financiers of philanthropy to pay for what they care for, to pay for outcomes, to pay for nature-based solutions. And there might be a little bit of subsidization that goes, for example, in terms of sweetening the interest rate or de-risking, but linking it to where I think there's not enough traction and where we don't have enough pace is actually linking the financing to things like soil health. And I know that there's a lot of evidence and going beyond carbon. I mean, I hope I don't open too big of a box, but there's an issue certainly of quality of the evidence and so on, but there's also an opportunity to actually start looking at how to, ecosystem services, paying for system services is still small and subscale, but even the price of carbon is not where it should be based on the demand out there. And I think there's a role for temporary and strategic subsidies to be used to actually help accelerate the transition.
Okay. Serena, I'll hold on you for a minute, but this is something that relates to something that James commented on just now. And either James or Vikram can pick this up, but what's the optimal post-pandemic additionality model in your mind? DFIs and multi-development banks should be considering, what is it that they should be considering to better mobilize institutional capital and franchise African capital markets in particular? Any thoughts?
James, did you want? I'll go first on that. That's fine. I think, look, it's become very clear, that it's in terms of how society is, where the safety nets are or not, what we're going to have to invest a lot. And if we're going to invest as much as we need to for a recovery post-COVID, why cannot and should it not be aligned with whatever the low carbon resilient pathways a country has taken? I mentioned supply chains, for example, right? Earlier, a lot of the supply chains are anchored in developing countries. And if you look at the numbers around supply chains, they're like nearly 60% of the world's emissions. If you include them all, 80% of all water use and 2/3 of global deforestation. So if corporates and institutional investors can, in fact, and the DFIs, of course, since that was part of it, that's one place we could be focusing. I already essentially mentioned cities. We've seen cities take the brunt post-COVID. There is a whole, and this goes to Serena's point, beyond carbon, right? I mean, how do we build a resilient society? We have to look at health. We have to look at sort of social safety nets, all of which can actually be done consistently with what all the other goals we are trying to achieve, right? So to me, there's a lot of opportunity here that DFIs and the rest of the financial sector has an opportunity to finance.
Okay.
Just to comment on, the role of governments, I think research, early stage research is so important. And I used to think that investors were the sort of top of the chain and that the world would follow the money, where the money's going. I no longer think that. I actually think investors are the followers, and it is the scientists and the entrepreneurs who are the real leaders, because they're the ones who are going to generate genuinely economically valuable commercial companies and technologies which will scale without the need of government. And so what we need is, and a fraction of the money going into climate solutions is really going into those brilliant scientists and angel investors and early stage people who are they are the ones who are going to save us. Plowing trillions and demanding that we plow trillions into current, rolling out of technologies that could be improved dramatically, and the cost curves come down even faster if we took even a fraction of that and put it into the earlier stage. So, I guess I'm just making a pitch for not treating all climate investment equally. The earlier the stage, the venture capitalists, the scientists, the people at MIT getting all of that stuff out of the lab, those are the people who are ultimately going to save the climate, in my view.
I love the way you're talking about investors actually following some of that technology, and thanks for positioning it like that.
I have an offer for you, James. I'll get in touch with you. I have a small 100 million catalytic fund idea that addresses pretty much all the things. Maybe not the MIT lab, but definitely all the entrepreneurs you talked about, all of them who need that $5 million to scale to 50 and ultimately, hopefully 500.
So we're bridging the gap on a call.
Exactly. I was about to say we've just facilitated one of the best deals. We'll wait for it in the press to actually follow.
Oh, Serena, I'm not in the fund selection team. So
I'm not in the fund management arena. So it's just, these are ideas.
Okay. Serena, I'm gonna ask you to do a quick 30-second snap answer to my next question if I can, and then I'm gonna wrap up this discussion. But we've had a kind of a question here about how much catalytic capital is really out there to help with the huge challenge of bringing down the costs and bringing down and making some of these deals sustainable and ready for investors to actually follow. What are your thoughts on that?
So compared to private finance, it's not as big. Although in climate finance, I think there's an equal share of public and private. It's more about how do you use that public finance, particularly now there's a lot of pressure with COVID, with allocation in the most strategic ways. And I think the scale of, philanthropic capital to private capital, maybe Vikram or James know better, is probably the billions to the trillions, So we're talking about certainly smaller numbers that can be, though, used in a very strategic, laser-focused way to help intermediaries and others to actually move to structures like funds of funds or bonds, then can attract the trillions. So there's hope in the small numbers.
Well, I'm glad that that's the case. I wanted to, so thank you for clearing that up. I'm going to stick with you for a second and just ask you to speak a little bit more about capital for adaptation particularly. Are there good examples that can be followed to create more balance with mitigation capital to serve perhaps African or emerging markets in particular? Any thoughts from you, Serena?
Yeah, it's not a space that I know as well. So I don't know, Vikram, you were nodding if you have more to say about this.
Happy for Vikram to take it if you'd like to.
I should unmute. Look, Serena said it right in the beginning. Mitigation overpowers all the numbers, right? And there's a reason for that. Broadly speaking, adaptation is very difficult to get a return on, as we know. So there are possibilities. Another graduate from the lab has raised about $200 million. It's called CRAFT. It's focused on adaptation services. Because that's where there is possibility for private investors, data analysis, service provision, planning. All of those are places where you can support adaptation. But adaptation itself is going to come from integrating resilience into everything we look at, whether it is government intervention through standards, whether it is institutional investors demanding that their investment be protected by, and integrating resilience into climate change and its impacts from ground zero. And there are a lot of work being done with institutional investors. There's this Coalition for Climate Resilient Investment. There is the Fast Infrastructure Initiative, all of which are convening around this issue. So it is something that I think it's to be, you heard it here, hopefully coming soon, but adaptation and resilience go hand in hand, and it is an emerging asset class, I think. Still a lot of work to be done, still a lot of convincing to show how investment today with benefits way out in the future can be integrated into analysis. And I think, honestly, we need to change the way we do discounted cash flow and the way we do standards and the benchmarks against institutional investors, in the benchmarks that James said many asset managers are incentivized to beat. We need to revisit all of that.
So it's almost maybe like reframing. Serena, you wanted to say.
No, I'll talk about a sliver of, thank you, Vikram, for framing the overarching, but where I work, particularly in sustainable land use and regenerative agriculture, a lot of investment opportunities encompass both. However, and maybe because of the need for simplicity, currently what is monetized is only the mitigation side, but there's a huge opportunity because these structures do both to start tracking and paying for adaptation and creating evidence, and then allows us, because often, so for example, in regenerative agriculture, you can sell carbon, and a lot of corporates or investors come into this fund with the desire to buy, to secure carbon for the longer term, which I think speaks to how much underpriced it is. On the other side, you have an opportunity to look at biodiversity and so on and monetize it, and maybe at the beginning it has to be paid by someone else, but it needs to start to be tracked, monitored, and paid for.
Just to comment on adaptation, firstly, I think it's very much under discussed. A lot of climate change is baked in, right? It's just a reality. It is going to happen, and all of the mitigation we're talking about, is not as much as the climate change that is going to be baked in anyway. So adaptation should be a much bigger discussion. But the other thing about adaptation is we've already been adapting in rich countries to extreme weather events and floods and so on, storms for 100 years. And the number of people who are dying from extreme weather events and flood events is like 1% of what it was 100 years ago. People were dying all the time 100 years ago from floods. They're not dying now. Why? Because we build flood defenses. So we need to continue building flood defenses. The best adaptation strategy for the Philippines is build houses that don't blow over when a typhoon comes over. So solid housing is probably the best adaptation investment. So actually, people should be thinking much more in terms of economic development is the best adaptation strategy for developing countries. And that's quite a diversified package of potential investments. In fact, it's almost universal. Economic development in those countries will necessarily overwhelmingly focus on adapting to those changes as they come.
So James,
just it needs a lot more cash, if I may say. Sorry, that needs a lot more cash, and nobody thinks it's worth it till it happens. There is a reason Miami keeps getting flooded every year or every other year, and people rebuild back, and people are still thronging. Philippines, it costs a lot more to do what you're saying, James. That's the right approach, but who's going to pay for it? And by the time people realize they should have paid for it,
well, who paid for New Orleans and the Netherlands to build their dikes? Well, the country when it becomes wealthier. So that's really the key is economic development in the poorest countries will necessarily result in huge investments by those people in adaptation. And that's how we did it.
Point well taken. I just don't think we have 100 years. And there is no way most of the developing world will become wealthy enough in the next 30 years to meet that kind of need.
So Vikram, on that very challenging note that we don't have 100 years, it's quite clear that some of the partnerships that we've talked about and the structuring and the packaging becomes quite important. So I'm going to start wrapping it here. And thank you so much for a wonderful discussion and the many thoughtful questions, many of which I could not get to, that we've had from our audience. A couple of highlights for me that I think are important. Firstly, the idea that scale and simplicity and safety matters, but packaging and intermediation and aggregation also helps to be able to actually make some of these opportunities attractive. I like the idea that James put forward of thinking about investors that might follow the innovations that are needed in the field. Liquidity and how that impacts a mismatch between, say, the need for short-term, but the longer-term horizons that also matter, and how do we get that bridge right? Clearly, there needs to be, we need to catalyze a viable pipeline of innovative solutions for institutional investors to make a measurable contribution to addressing climate change beyond just, say, decarbonizing a portfolio. It seems to me that partnerships and working together are key to moving institutional capital to climate solutions. And I'd like to end with a quote from Al Gore that also references my African roots. And it goes like this: There's an old African proverb that says that if you want to go quickly, go alone. If you want to go far, go together. We have to go far and quickly, and that means that we have to quickly find a way to change the world's consciousness about exactly what we're facing and how we have to work together to solve it. So with that, I really want to say a huge thank you to Vikram, Serena, and to James, and to most importantly, to our wonderful audience. Thank you so much.